Director of Investment Management with Argent Bridge Advisors. Welcome to Cup of Joe. We hope everyone had a fun and festive end to 2024. What a year for the markets it was. The S&P 500 index that returned 25%, and that makes it 2 years in a row that the index was up that much. U.S. midcaps and small caps returned in the low double digits. International and emerging market stocks contributed modestly, gaining about 4.5% and 8% respectively between those two. The aggregate bond index, that was positive, a little over 1%, while that was dealing with a swirling interest rate environment pretty much throughout the whole year. So those are what your major asset indexes did. And once again, it appears that the top dogs of performance were areas that have dominated performance for the past 2 years. Namely, that's U.S. large cap stocks, and to a greater extent, growth style stocks and tech stocks. And in fact, I saw the stat last week that the Mag 7, which are the 7 biggest stocks in the S&P 500 index, we've talked a lot about those, those 7 stocks accounted for over half of the S&P 500's price return in 2024. Now, if you ask me, that's a pretty significant concentration of performance in just a few names. So with return spreads of different asset classes spread out so much last year, it might be natural to feel like you want exposure to what just did well. Now, this is called chasing returns. And the human tendency to chase returns, that can be a dangerous trap, and I'll tell you why. The problem with it, besides buying what has just gone up the most in price, the problem with it is that chasing returns, it's an endless game of comparing one asset class to another, and it becomes a grass is always greener type situation. Now imagine this, you start with your diversified portfolio, and then you start to wonder, well, stocks did way better than bonds. Why aren't I just in all stocks? Then you say, all right, I'm in stocks, but US did better than international. Why am I not just in international stocks? Large cap stocks did the best. Why aren't I just in large cap? Well, within large cap, tech has just been crushing it. Why aren't I all in tech stocks? Looking at the tech stocks, NVIDIA has trounced all of the other tech stocks. So why don't I just own that? And you see my point here. In investing, there's always going to be some other asset class or security that did better. And since the time frame that you're looking at is continuously changing, there's literally infinite possibilities to which you can compare things. And this will naturally lead to disappointment because it's an impossible and exhausting feedback loop, right? So we don't want to focus on the high-flying asset classes of the day. And an interesting saying I hear around is that comparison is the thief of joy. And it seems in investing, comparison is going to be the thief of peace of mind, right? So remember that diversification, that helps you control risk. So focusing on the risk you controlled and not on what you didn't earn is the perspective we want you to take. So let's look at the year ahead, 2025. In the past 2 weeks, I've read more than a dozen or so outlooks on the markets from various investment companies and very smart strategists. And the opinions are uniformly positive. Now, not in an over-exuberant way. Some are definitely more cautious than others about the year ahead. But they all seem to agree on several key points, which I want to share with you today. The first point is that it's prudent to recognize that right now there are certain risks in the near term. A couple of those risks include a slowdown or a pause in the cutting of interest rates by the Fed, and the fact that stock prices are really stretched right now at the top of the stock market. I saw the term out over our skis mentioned a couple of times. Now, these risks may cause some volatility here in the near term, so we should expect that, and don't be surprised when it happens. Number 2, despite these risks, the U.S. economy is on pretty solid footing, and that sets up a landscape that's definitely supportive of stocks. So we love hearing that. Number 3, there are pockets of the market, not just the U.S. market, but the global market, that present very good buying opportunities. These areas, they're relatively cheap, and the long-term outlook for them shows a lot of upside. Two of these areas that were mentioned frequently are US small cap stocks and international stocks. So that's good to see. For bonds are providing very good coupons for investors right now. Coupons they haven't offered for the better part of 15 years now. Bonds are now a meaningful diversifier in your asset allocation, and bonds should enjoy some appreciation along the way as rates slowly continue to fall. So we feel that these last three outlooks, they certainly bolster your personal financial plan from the area of and the role that your investment portfolio plays. Now, speaking of your financial plan, we want to coach you again that it's always of the utmost importance to control what you can control. Now let's talk through a couple of those things. The first, obviously, is spending. Your weekly, your monthly, annual spending. Always try to be aware of what you're spending and be mindful of ways that you can adjust that if you need to. Also, since it's the start of a new year, if you're planning big purchases later, start thinking about those purchases now. Setting aside some money now while the market's elevated, that can make a lot of sense and be beneficial for you. Or if you're thinking of financing whatever your purchase is going to be, if you can time that or maybe delay it until interest rates are lower, that would obviously be helpful to you. Number two, your savings rate. Look for ways that you can increase the amount that you're saving and investing, and definitely automate it if at all possible. Number three, media exposure. Be mindful of what you're watching and reading when it comes to the financial press, because their job is to put out headlines and sensationalize things. Their job is not to worry about how it affects you. Number four, educate yourself. If there are things that make you nervous, or if there are things that you don't fully understand, maybe like interest rates or tariffs, things you hear about in the press, ask us to gain more clarity, because clarity is going to give you that peace of mind. I think of a really cool story I heard about the pop singer, Kelly Clarkson. She used to be afraid of flying. So what she do about her fear of flying? She learned to fly. Now, if that's not connecting uncertainty with clarity, then I don't know what is. I think that's really cool. So, gaining more information helps frame grounded expectations. And those are going to do wonders for your emotional outcomes when it comes to your money. So simply put, educating yourself can save you a lot of stress. Now, finally, it's a new year. You may have new financial goals. So if you have new goals or priorities, write them down. Take an honest look at what it's going to take for you to work toward them, and then share all of that with your advisor, because our goal is to help you succeed in achieving yours. Can't wait to do that. Thank you for watching Cup of Joe. Good to see everyone, and we will see you in February.